What if I told you that some of the most beautiful cities in California, the ones people dream of moving to, might actually be the worst places to buy property right now? Welcome back to the Globe Realty, and in today's episode, Top 10 California Cities You Should Avoid Buying Property in Right Now, 10 Risky Cities to Avoid. We're diving deep into the hidden risks behind California's most overhyped real estate markets. From skyrocketing insurance premiums and unsustainable price-to-income ratios, to rising inventory and silent buyer pullbacks, we've analyzed real data and trends that reveal which housing markets could be on the verge of a major correction. If you're thinking of buying a home, relocating, or investing in California real estate, this is one video you can't afford to skip. Stay with me till the very end, because the city that lands at number 1 will completely change how you see California's housing market. Don't buy blind, don't invest on hype. Hit that subscribe button, turn on notifications, and let's uncover the truth behind California's riskiest real estate zones. Number 10, Los Angeles. Alright, kicking off our list at number 10, Los Angeles. Now before you roll your eyes and say, well, of course LA is expensive, let's look beyond the obvious. Because the numbers here aren't just bad, they're borderline unsustainable. Think about this. The median home price in Los Angeles right now hovers around $896,000. Meanwhile, the median household income is only about $93,000. That means the average Angelino would need to spend nearly 78% of their income just to afford a typical home. 78%. Tell me, could you survive if 3 out of every $4 you earn went straight to your mortgage? And here's the real shocker. The California Association of Realtors says that only about 29% of households in the LA metro area can afford an entry-level home. That's not luxury, that's entry-level. So for every 10 people you see walking down the street, 7 can't afford to buy where they live. Now, some might say, but LA is resilient. Prices never drop there. Really? Then explain why over 20% of listings in LA County have seen price cuts this year. Sellers are realizing buyers just aren't biting anymore. And inventory? It's quietly rising, now sitting around 3.5 to 4.4 months of supply, compared to under 3 months not too long ago. That's a sign the tide is shifting. Let's be honest, Los Angeles is starting to feel like a real estate illusion. Great on postcards, painful on balance sheets. Yes, the palm trees, Hollywood Hills, and coastal sunsets sell a dream, but for most buyers, that dream comes with a 6-figure mortgage trap and a lifestyle that's harder and harder to sustain. So I'll ask you, would you buy into a market where growth has flattened, affordability has collapsed, and insurance and taxes keep rising year after year? Los Angeles might still look glamorous from the outside, but under the hood, it's becoming one of the riskiest housing markets in California, especially if you're a first-time buyer or investor chasing ROI. Stick around, because as we move down this list, the next city might surprise you even more. Number 9, the Bay Area. Alright, coming in at number 9 on our list, the Bay Area. Yes, that place people call the tech mecca, startup central, and home to some of the priciest zip codes on the planet. But under the flashy veneer, there are serious warning signs. Let's talk numbers. The California Association of Realtors reports that the San Francisco Bay Area's median home price for a single-family home is about $1.3 million. To afford that, with taxes and insurance, you're looking at needing a minimum income of around $335,000 a year. That's not chump change. Who in the Bay Area really has that kind of income? If you're like many viewers watching this, probably not you. So that's strike 1. Affordability is basically off the charts. Now, believe it or not, even listings here are showing cracks. A large share of people selling in San Francisco and Oakland are reducing prices, some by tens or even hundreds of thousands. Buyers are pulling back. They're softening demand underneath those steep price tags. Yes, luxury homes might still move, but the broad base, less so. And it's not just homeownership suffering. Renters, too, are bleeding. Over half of Bay Area renter households are cost-burdened, meaning more than 30 to 35% of their pre-tax income goes just to housing. That leaves less for everything else: food, childcare, savings, emergencies. So here's the big question. Are you okay with being stretched this thin, where your housing payment alone limits your lifestyle, your savings, your ability to plan for the future? If you have to give up so much just to live in a place, is the prestige or view worth it? Now, I know some of you will say, but the Bay Area still has the highest tech salaries, great schools, quality of life, proximity, culture. That's true. But here's the controversial part. Those benefits are becoming luxury premiums, not baseline expectations. You're paying extra for those, often with diminishing returns. In short, the Bay Area looks glamorous. But for many buyers, especially first-timers or those hoping for steady real estate gains, it's risky. If the market flattens or interest rates stay high, you might end up carrying more cost than any potential upside. Number 8. San Diego. Okay, sliding into number 8 on our risk list, San Diego. If you think San Diego is just sunshine, surf, and high demand, you're right, but there's trouble brewing underneath. Let's break it down, and I'll ask you some questions so you can really decide if this is somewhere you want to tie up your money. The median home sale price in San Diego recently reached about $880,000 to $1.1 million, depending on the city or zip code. Detached, single-family homes are well over $1 million in many desirable neighborhoods. To afford a typical home, buyers now need to bring in around $240,000 to $266,000 per year in household income, assuming they want to keep mortgage payments within a reasonable share of their earnings. Ask yourself, do I have or expect to have an income this high while also covering taxes, insurance, maintenance, and other rising costs without breaking my budget? San Diego's price-to-income ratio, how many times the median home price exceeds median household income, is approximately 8 to 9 times, meaning homes cost 8 to 9 times what the typical household earns. That's far above what's considered sustainable. Only 17% of households in San Diego County actually can afford a median-priced home. That's a tiny slice of the population. So when people say, oh, but the San Diego lifestyle? Yes, amazing. But you've got to ask, can your wallet survive the price tag hidden in that lifestyle? Homes are taking longer to sell. Median days on market have increased. That tells us buyers are pausing or hesitating. Rents are still high, and newcomers or even locals renting aren't getting reprieve. That limits the rent versus buy trade-off. Many are stuck paying absurd amounts in housing, even if they rent. And here's the kicker. Climate and insurance risks are rising. Fire, flood, and other natural hazard risks accompany elevated insurance premiums. That's extra cost, extra uncertainty. Even if the home value holds, your cost risk is going up. If you're watching this planning to relocate to California or thinking about investing or buying your first home, San Diego may look ideal. But the data suggests it's one of the worst bets right now in terms of return, affordability, and risk. Would you rather stretch now and hope for gains, or wait until a more reasonable opportunity opens up? Because in markets like San Diego, reasonable seems far away if the trend holds. Number 7. North Tustin. Okay, we're now at number 7 on our list, North Tustin. On paper, it looks like affluence, prestige, stability. But when you peel back the numbers, you see some sectors stretched to breaking point. Let me walk you through why North Tustin is showing up as one of the risky cities to avoid right now. The typical home in North Tustin is going for about $1.7 million. We're talking median values of $1,695,000 according to Zillow, with a one-year gain of roughly plus 2.0%. Rocket reports the median sold price in mid-2025 was $1,716,250, up about 5.6% year-over-year. That's still strong, but compared to the double-digit jumps we saw in many markets just a couple years back, it's cooling. Homes are staying on the market longer. Redfin reports a median days on market of about 59 days in August 2025. That's significantly higher than this same period last year. People aren't rushing to buy at any cost like before. Also, we see year-over-year declines. Median prices down from 4.9% compared to a year back in some datasets. That suggests the market is trying to digest what's been priced in. Median household income in North Tustin is only about $186,000 to $187,000, depending on source. Meanwhile, with home values near $1.6 to $1.7 million, the price-to-income ratio is astronomical. Many households would need incomes well above that median, plus large down payments, just to keep debt service manageable. Because when you buy in North Tustin now, you're paying more for less margin for future gains. The major jumps seem mostly already baked in. The risk of a correction is real. If rates stay high, if demand softens further, or if buyers decide they've had enough of overpriced luxury. Also controversial, people move here expecting stable appreciation, safe investment, premium lifestyle. But when homes sit longer, price cuts creep in, or smaller buyers are priced out, that safety gets questioned. Would you feel comfortable buying a $1.7 million home in a place where value growth is no longer accelerating the way it used to? If prices drop 5 to 10%, are you protected, or are you over-leveraged or stretching too thin? Is the prestige, school district, or location worth paying a premium that may offer very limited returns going forward? North Tustin is beautiful, in many people's minds the dream. But right now, it's also one of the most exposed. High valuation, slower appreciation, and an affordability stress test asking buyers whether the risk matches the reward. Number 6. Aliso Viejo. On the surface, it looks appealing, but the data suggests it's one of those cities already pushing too hard, with real risk baked in. You've seen the headlines: Aliso Viejo home prices up 8.3% year over year, and that's partly true. Redfin reports the median sale price is around now $980,000, up 8.3% compared to last year. But here's where things get worrisome. Homes are staying on the market longer, and sales volumes are dropping. That's a classic top-of-the-cycle sign. Rocket's most recent numbers show a more modest gain, only 2.4% year over year, with a median price of $922,000. That discrepancy between aggressive gains and these more conservative stats is your early warning. The market is being stretched. In Q2, Aliso Viejo even showed a 3.2% drop year over year for the median home price in some datasets. And while the per square foot price is still holding, around $700 per square feet, the volume of transactions is down. In that same Q2 period, 108 homes sold, about 9% fewer than the same period the previous year. So ask yourself, when price gains start cooling or even reversing, are you in a safe position, or are you one of the ones who bought late? Here's another angle. In hot markets, buyers often chase momentum. You jump in because you fear missing out. But with Aliso Viejo, some of that momentum may already be baked in. The long-term trend has been solid, a 10-year average appreciation north of 7% annually. But that's the past. The near term, moderating growth, more inventory, weaker volume, and price gains are starting to outpace what local incomes can support. This kind of disconnect often leads to corrections or flatlines, not large spikes upward. Let me be a bit blunt. Aliso Viejo feels like a luxury sports car at full throttle. Exciting, sure, but if there's even a little incline ahead, it can quickly lose momentum. If you bought near the top, you may be stuck. Would you be comfortable buying in a market that's showing slowdown signals when the biggest gains may already be captured? Could you live with zero or negative returns for a stretch? Aliso Viejo may still look shiny. But in this list of risky California cities, it's dangerous because it's overextended. And when markets revert, they don't warn you. If you are finding this video eye-opening, do me a favor and hit that like button, subscribe to the Globe Realty, and turn on the notification. It will help us reach out to more people who equip themselves with real insight into real estate before investing. And now, the top 5 on this countdown. Number 5, Visalia. Under the surface, the market in Visalia is starting to bend under pressure, and if you're not careful, you might get caught in the slip. You might see headlines that Visalia's home prices are up slightly. Redfin shows the median sale price around $403,000, up 0.1% year over year, with homes moving in about 27 to 28 days on market. And Rocket reports a median price closer to $416,000, a 4% increase compared to last year. But here's where things get tricky. Those gains are weak compared to earlier surges, and they mask deeper stress. We're seeing price cuts and incentives creeping in. Local sources suggest nearly 1 in 5 listings in Visalia had reductions as sellers respond to weaker demand. That's not a rounding error. It's a signal that some sellers who rushed in when the market was hot are now feeling the pressure to adjust. The growth momentum that once fueled Visalia's rise is now decelerating. Earlier, buyers might have assumed a steady upward trend, but with gains flattening, that assumption becomes dangerous. The value-to-income ratio is becoming less favorable. When your purchase price outpaces what local buyers or renters can afford, you're depending heavily on outsized appreciation to bail you out. That's a bet, not an investment. Let me put it this way. If this market were a car, it's now showing signs of over-revving, a little downshift, and it stalls. If you buy now, assuming future leaps, what happens if those leaps don't come? Ask yourself, would you buy in a place where you see moderate gains, but also signs of pullback? If price cuts and weaker demand keep increasing, could your investment sit flat? Or worse, bleed value? Can you carry the costs, mortgage, insurance, maintenance, if for a few years your property just churns? Visalia isn't collapsing yet, but it's starting to strain under its own weight. So today it's high risk, not because the fundamentals are terrible, but because the margin of error is shrinking. If the market bends one more degree, many who bought late will be exposed. Number 4. Oxnard. Oxnard's median home sale price is sitting around $767,500, down about 3.5% year-over-year per Redfin's latest report. Meanwhile, the market is slowing. Homes that used to move in a few weeks are now seeing median days on market climb, about 61 days currently, up from roughly 47. That kind of shift suggests buyer caution creeping in. But here's where it gets interesting. Oxnard is showing price reductions in many listings. On Realtor.com alone, dozens of homes are actively flagged as price reduced in Oxnard. That tells me sellers are trying to recalibrate expectations. If you're looking to buy there now, don't assume everything is still going up without pause. Inventory is loosening too. Movoto reports there are 368 active listings in Oxnard, and 75 of them are already price reduced. That combination? More houses for sale, many of them with cuts, is red flag territory. It often precedes flat markets, stalled gains, or even gentle corrections. One more twist. While some pockets are sliding, others in Oxnard are still showing strength. For example, in the Oxnard Shores neighborhood, median sale price recently hit $1.3 million, up about 4% year-over-year. Yet homes there are taking much longer to sell, 101 days on market in recent reports. That kind of discrepancy shows uneven strength. Some areas holding up, others bending. So for you watching this, would you jump in now in a city where broad prices are slipping, inventory is rising, and sellers are cutting? What if your part of Oxnard is one of the weaker zones, or one that takes a year to bounce back? Here's the punch. Oxnard still has upside potential thanks to coastal location and proximity to Ventura, Los Angeles markets. But buying without respect for these cracks, discounted listings, rising inventory, mixed performance, increases the gamble. You might still win, but your margin for error is shrinking fast. Number 3. Fresno. Fresno's average home value is about $386,275, and it's down 0.5% over the past year, according to Zillow. At first glance, that doesn't scream crisis, but dig deeper and you'll find cracks. Nearly 20.3% of homes for sale in Fresno have been discounted. That's 1 in 5 listings taking price cuts. And that's exactly the kind of red flag you don't want to ignore. Now, compare that with the hype you often hear. Fresno is still cheap. It's the Central Valley's safe bet. Sure, relative to coastal California, yes, but cheap doesn't mean safe upside. Because when sellers start marking down prices, it tells you demand is under pressure. It tells you buyers are no longer chasing at any cost. Last year wasn't easy either. Experts say sales volume in Fresno dropped about 31% in 2024, one of the steepest declines in a long time. And values have lost between 10% and 20% since 2022 in many parts of the county. That's not a bubble collapsing. It's a market trying to find a new baseline. Fresno remains one of the more affordable California markets, yes. Forecasts suggest modest growth, 3 to 5% in 2025. But modest gain in a market showing discounts and weakening volume? That's not a guarantee counteracting risk. Here's where it gets controversial. Many buyers who move to Fresno thinking they'd hedge against cost will find out it's still a leverage bet. The cushion is thinner than it used to be. Imagine this. You buy in, say, Clovis or Tower District, banking on steady appreciation. What if instead you see flat years or pullbacks? How long can you hold without stress? How much buffer do you have? Also, the local real estate association now says that homes in the Fresno-Clovis area take around 40 days to sell. And many are being romanticized, sellers still pricing as though buyers would meet last year's prices. That mismatch is dangerous. It means sellers and buyers are increasingly out of sync. My question to you: would you buy in a market where discounts are widespread, sales are down, and future growth looks polite, not spectacular? Would you risk being stuck waiting for the bounce? In Fresno, you're not necessarily walking into a collapse, but you may be walking into slim margins and high dependency on timing. Number 2, Riverside. The signs here are too loud to ignore. Many homes are being discounted, affordability is slipping, and growth feels tired. Let's walk through why Riverside is now on this risky-to-avoid radar, and whether you might still take the bait. First, price cuts are real and rising. Riverside County just recorded a 1.1% drop in median home price from April to May 2025, and compared to May last year, it's down 0.9%. That's not a tiny wobble, it's a market recalibrating. Meanwhile, data from Reventure shows that in Riverside, nearly 24% of homes for sale have already had at least one price cut. Think about that. 1 in 4 sellers having to lower expectations. That's a signal buyers aren't chasing like they used to. Look at how Riverside home prices are doing more broadly. Redfin reports the current median sale price is $625,000, down 1.6% year over year. Homes are also staying longer on market. Median days on market went from 32 days a year ago up to 63 days now. That's not a cooling whisper. That's the market catching its breath. Now let's talk affordability versus income. Riverside County's median home price sits well above what many local households can truly bear. Zillow data reveals that to buy a typical Riverside home today, monthly costs, mortgage plus taxes, insurance, would approach $4,220, numbers that leave many families stretched thin. In fact, Zillow suggests rates would have to fall to 1.27% just to make such a home affordable to many median-income households. If that's not highlighting a valuation imbalance, what is? And there's more. Residential sales in Riverside are weakening. Redfin indicates only 161 homes sold in a recent month, down 11.5% year over year. When demand softens and sellers have to reduce prices, the margin for upside shrinks fast. So, what does this all mean for you, the investor or homebuyer watching this? Are you willing to enter a market where nearly 24% of current listings have already conceded value? Where monthly costs are pushing the limits for locals? Where homes take twice as long to sell and growth is reversing? You might face years of flat or even negative returns before things normalize. Yes, Riverside still has population growth, some economic momentum in the Inland Empire, and appeal from buyers priced out of coastal areas. But those positives are no longer enough to offset the strain. Here's a provocative question. Would you rather buy now at risk of being underwater for years, or wait for a more stable, less overstretched market? Because in Riverside right now, you're not buying growth. You're buying speculation on whether discounting and weaker demand reverse. Number 1. Stockton. And yes, this city tops our list for a reason. A shocking number of active listings are already getting price cuts, a sign that buyer demand is faltering. But there's more going on beneath the surface. And that's exactly why Stockton is number 1 on top 10 California cities you should avoid buying property in right now. Let me walk you through why Stockton is practically waving a red flag. First, Stockton is leading the state in price reductions. In fact, 25.4% of home listings in Stockton have seen downward adjustments. That's 1 in 4 sellers lowering their asking price to attract buyers. That kind of volume just doesn't happen in a healthy, balanced market. Realtor.com currently shows 265 price-reduced homes for sale in Stockton. Next, median prices are slipping. Zillow reports the average home value in Stockton has dropped 1.8% over the past year. Redfin's more striking. Stockton's median sales price is down 8.7% year over year in recent reports. That's not a mild correction, that's significant downward pressure. Contrast that with past assumptions. Stockton once had a reputation as a more affordable alternative in California's expensive market. But now, with this many discounts and a weakening top line, that affordability cushion is disappearing. Here's some questions you should pause on. If 1 in 4 homes in a market are being discounted, would you be comfortable buying at a price you believe might soon be forced down? What if your particular neighborhood is one of the weaker ones? Even neighborhoods showing strength now could get pulled down when market sentiment shifts. These price cuts suggest sellers are now chasing buyers, not the other way around. What happens if buyer demand continues to shrink? What happens if mortgage rates stay high and fewer buyers qualify? The risk isn't just that your property stagnates, it's that you could see negative returns for years before things recover. Stockton is not imploding, not yet, but it's showing signs of being overextended. The market is no longer riding on momentum alone. It's being tested for weakness, and many buyers arriving now might walk right into the test. So yes, Stockton sits at number 1. The number of price cuts, the downward price trends, the weakening demand, it all adds up. If you're watching this and thinking, should I buy here? I'd urge you to think twice, dig deeper, demand up-to-date comps, and remember, in real estate, what happens after you buy matters far more than where you buy. And that wraps up our countdown of the top 10 California cities you should avoid buying property in right now. A list that might have ruffled a few feathers, but it's the truth buyers need to hear. Let's be real. California's housing market isn't collapsing, but it is shifting. We're seeing rising inventories, price cuts, and buyer hesitation across markets that were once red hot. From Los Angeles to Stockton, the message is clear. Not every dream home is a smart investment right now. But here's the thing, this video isn't about fear. It's about awareness. Every great investor knows timing and location can make or break your ROI. So if you're planning to buy in California in 2025, take this data seriously. Look beyond the hype, the palm trees, and the ocean views, because even paradise can be overpriced. Now I want to hear from you. Do you agree with this list? Are you seeing price cuts or slowing demand in your city? Drop your thoughts in the comments below. I'll be reading every one of them. And if you found this video eye-opening, don't just click away. Hit that like button, subscribe to the Globe Realty, and turn on your notifications for weekly real estate insight. Thank you for watching, and see you in the next one.